Financial professional with us, Eric Crom from Clear Creek Advisors. You know, you guys help people with all of this stuff, right? Managing all this stuff. And I know there are some small changes this year that are probably good to know about. What's going to be different this year versus if we did it last year?
Yeah, as you mentioned, really the changes this year are pretty small. Although it is good to note in 2026, the old rules have a potential of sunsetting. So we could be looking for some more material changes then. But this year it really boils down to brackets, standard deductions, and tax credits. So,
are they changing for the good, for the better?
Yeah, just a bit, right? So everybody's felt the impacts of inflation, and one place that will get a little bit of tax relief is the indexing of the tax bracket. So rates stay the same, 12 still 12, 22 still 22, but they will move up a little bit, so you might have a little bit less money that's taxed in a higher bracket. Same thing for standard deductions, also just a little bit of increase. Now that so many people use the standard deduction, very few people itemize, so it is really important. That's gone up to about $13,800 for a single filer, and then double that for a joint filer.
Any changes when it comes to like child tax credits and some of the little refunds people expect every year? Yeah,
those have changed as well. So, I mean, in case of those, I think it's always good to consult a CPA. Yeah. When we talk to our clients about those things, we always want to bring in a tax professional. But maximum income tax credit is increased, EV tax credits, and then as you mentioned, there are some changes to the child tax care.
Well, in managing all of this, you know, it's January when you should really start thinking about next year's taxes, right? Because if you manage it better throughout the year, you're probably in a better situation when it comes time to actually file it.
Yeah, for sure. One of the things we talk about is looking out 12 months at a time, and there's really three reasons we do that. One is just kind of the mindset, right? You want to try to save every dollar you can in taxes. If you do it the right way, that means more money saved, compound interest, right? All that good stuff. The other reason is deadlines. Some things don't have a deadline of April 15th, right? Roth conversions, as an example, they have to be done before the end of the year. So if you wait, you might miss that.
Too late, yeah.
Exactly. And then the last thing is market related. When you're planning for taxes from an investment perspective, some of those things are really driven by kind of finding the optimal time throughout the year from a market standpoint. And so if you wait too late, you're going to miss those things. So what we do is earmark those things. Here's all the things we want to do over the next 12 months. And then that way you're just kind of watching the market throughout the year. And if things present themselves, and you know, take advantage when the timing's right.
So what are some of the things that we can do personally to kind of lower our tax burden?
Yeah. You know, our specialty is investments, right? So we think about really the $64,000 question is, do you want to save taxes today, or do you want to save taxes down the road? And the reality is the decisions that you use to save taxes today, they're probably going to compound the tax burden down the road, and vice versa, right? So if you're trying to save taxes today, retirement plan contributions, HSAs, if you use those are all going to create a tax deduction today. But unfortunately, they're going to compound money that's available for you in retirement, and so you may have heavier taxes then. On the contrary, if you do things like Roth contributions, Roth conversions, brokerage accounts, really you're making a decision to pay the taxes today, and that's going to help you get better compound benefits for the future. You know, having worked with retirees, I would say that a lot of times people end up with a lot of money in retirement accounts. Yeah. And so having that tax diversification generally we think is a good thing. So a lot of times it's a combination of the two.
So maybe you have some that's taxed now and some that's taxed when you retire or pull that money out.
Absolutely.
And how do you know when it's too big, whether it's taxes or just managing your money throughout the year, that they should call somebody like you guys?
Yeah, you know, we always talk about it's just an incremental benefit, right? At the end of the day, it's never one thing that changes it. It's all about doing the right things over and over and over again. And some people like to do it themselves. Some people feel like they really know what's going on. Other people really feel like they need help. So I think it's always exploratory, right? You just find people that you feel good about and see what they can do. And
yeah, you don't want me doing my taxes, all right?
Well, definitely from a tax professional.
Yeah, have a tax professional do your taxes or something, I mean, depending on how complicated it is. Because if you're a single filer, single income, you know, depending on your income, it's probably pretty easy. But you start adding spouses and kids and other businesses and stuff like that, it gets complicated.
Yeah, particularly if it replicates itself year after year. Yeah. You know, you're just kind of doing the same things. But if you have out-of-state properties or, you know, big kind of things that happen throughout the year that might be a little bit different, those are always great times. And then if you're just kind of setting the structure, right? So if you have changes in your life, you're going into retirement, you're changing jobs, I think it's always nice to have somebody get the structure built, and then, you know, potentially you could do it on your own from there.
Well, thanks.
Yeah,
Appreciate
thanks for
the
having me.
advice.
Appreciate it.
Yeah, good to have you.